Welcome to the March 15th edition of Market Thoughts. I'm Dave with Lighthouse. As predicted a week ago, this is now the most interesting week of March as you had another week of incredibly volatile trading. Crude oil Sunday into Monday morning traded in a larger range, roughly $38 a barrel during a 3-hour period than in the previous 3 years, top to bottom combined. So extreme volatility, a lot happening, a lot of profound impacts to the markets. We'll get back to this teaser chart we're showing here, but first, quick advertisement, promo, if you will. This is something we want to hit on now. This probably doesn't mean much, this graphic to you, but huge milestone at Lighthouse. Actually, we've been talking about this. We've been talking about our AI efforts. We are actually now, as we speak, automatically creating contracts in our enterprise software from a fill. So if you give us an order and we place it, and it fills, it automatically generates that contract. Instead of a human having to do that, you're talking about thousands of hours of saved administrative work, higher performance, and all that time rededicated to better serving you, the client. We are on a mission to put to bed any administrative work. This is one of a big milestone at Lighthouse, one to celebrate, and there'll be plenty more as we attack this every single day operationally while we do right by you on the marketing. So we're going to get into what, in all seriousness, may be one of the most impactful weeks where we've got to make some decisions on markets that we encounter in quite some time. But first, preface it all with just looking at our weekly changes. Here's what Maycorn managed to do. Up 6 3/4 cents. Good. Not that crazy, right? Well, if you look at the broader, that's right in the middle of a range that saw it from a low of 445.5 to a high of 476. How does this look overall? That 476 high, you got to chase all the way back here into early June for the last time that corn futures were that high, the May contract and continuous contract. If you use that metric, you got to go even further back to almost April for the last time that we saw futures at that level. But at the same time, this is not a chart that makes you feel warm and fuzzy or gives you goosebumps or any good vibes, because here's your spike high. Here's your effect to reclaim that, which is very common, and so far have been unable to get through. So trend is still nicely higher. Spike high hasn't been taken out yet. You're at a critical spot here. You got to make a new high soon, or this fits very well with a significant high being in place. All right, chasing over to soybeans. How did this play out? Here's how this looks on a weekly chart. 24.5 cents, not too shabby. Closed at 12.25 1/4, cleared that psychological $12 barrel. Bean mark, not barrel. Mark, beans actually look better here. Here was your breakout. Here's your brief consolidation, another orderly leg higher, sharp spike higher. Had the same thing happen Monday, of course. Reclaim those losses, move to a new high on Friday. Just below it is where you end the week. So the bean chart looks better, just if you're thinking of nothing else other than the chart. This is still a pretty healthy uptrend, not quite as alarming as corn. And then if we flip over to wheat, here's what wheat managed to do. Up 2.5 cents on the week, but this was well off a high of 669.25, all the way back down to 645. That 669 level, that takes you back to late June on continuous, early July on the actual May contract for the last time you were at that level. Here's how this looks on a daily chart. Your breakout higher, your huge move, your spike high on Monday, and you haven't even really gotten close to reclaiming all those gains. So this wheat chart looks a little more ominous, actually kind of a bearish flag pattern that you're setting up here, pendant pattern, just from a chart standpoint. So that's what we got done in a weird way in the context of crude oil, of the war news, of the implications of all that. A little bit underwhelming on grain. To tack on 6 cents on corn, just a couple cents on wheat, and a quarter on beans really is not that incredible. But at the same time, if you flip over to new crop, November beans, December corn, highest price levels we've seen in a little over 2 years for the new crop contract at that moment in time. Okay. So a little bit different here. I think we're going to start with the ending, if you will, because here's the takeaway, and we have to work backwards from this. So this is where we sit now. Prices are at, if we use new crop, prices are at 2-year highs. They're at profitable levels, at least up here in the northern belt. Corn has really nice profits, and soybeans are back to decent profits, and especially on corn if you pre-booked your fertilizer. And you're above the sell threshold on new crop corn, beans, and wheat, and canola. New crop 26 contract, all four above the sell threshold at the same time. All right, so then we span down to market gauges. These don't always get the credit they deserve, but if you look at this now, everything except your seasonal, we have a bullish seasonal now. This is a counter seasonal move to rally right now. Everything else is extremely high. And let's call out these last two. Price to stocks to use is in the 82nd percentile. Just a reminder what that means. That means for the current stocks to use, what the USDA gave us on, gosh, what day was it? Tuesday stocks report, that the price range we would expect corn to trade in with that stocks to use, you're at the 82nd percentile. So nearly the top of the range we would ever expect with that stocks to use. Here's the headline though. Spec net buying market gauge skyrocketing to almost 100. You had in the top 4 biggest weeks ever of managed money buying corn is what we learned here. And this was through Tuesday, and even with the Monday meltdown, you're now to almost to 100 on our managed money spec net buying market gauge. Again, just quick reminder, specs move the market. When everybody's bought, there's nobody left to buy. That becomes bearish. So this is a ominous warning sign. And worth noting too, the other 3 weeks, there was one in 2019, one in 2017, and one in 2015, when we saw this much spec net buying in 1 week. All 3 featured sharply lower corn prices later, from anywhere from 1 month to 4 months later. So just, this is a warning sign. The signal is a warning sign. Momentum and expected range are high. If we look at soybeans, flip over to new crop, sell signal 92, 100, 193. Again, bullish seasonal. We're in a counter seasonal move right now, but the market gauges are through the roof, both the long-term price to stocks to use, spec net buying, and short-term. Look at wheat. Maybe wheat will tell us something different. It will not necessarily. Spec net buying also at 100. They've hung in there and piled into wheat length too here over the last couple of weeks. Seasonal's bullish, range of momentum though, and price to stocks to use currently at the 55th percentile. So this is where this fits, and new crop wheat is also above the sell threshold. So we say all that. We also pair this with, find the spread chart. We hit on this last week. During this rally, during this big move, cash markets have said, no, not necessary at all. Normally you would think in a healthy rally, people are struggling to find grain. So the cash market basis improves, then spreads narrow, then futures take off. At a minimum, you would expect basis and spreads to stay consistent in a rally where there's at least some pretense. This is really unusual. There's only one other instance where we've seen this, where spreads widened, got worse, more carry, basis got worse, etc., during a rally where that rally actually sustained. We'll talk about that one outlier shortly here, but just noting this now. So if we're building a case on grains today, we've got profitable margins, we've got prices at multi-year highs for new crop futures, we've got a sell signal, we've got price to stocks to use and managed money market gauges nearly 100, super high. We've got these huge red flags in the cash market with basis and spreads widening. What else do we have here that we need to talk about on the front end of this? We look at classifier. Corn is neutral. We're actually not learning anything here right now at the moment, but worth noting it was bearish earlier in the week or tail end of last week. Soybeans, still bullish. They've been bullish this whole time, and that's what's kept us long beans, what's kept us patient, why we haven't stepped in and sold beans like we have on corn and whatnot. So the classifier is still bullish, but in the face of all this other news, it's getting tough to rely on that alone. Wheat, not a lot of data points, but the ones that are extremely bearish classifier in wheat. You can see the similar instances here. Every single one of them featured a significant collapse in the days ahead. So our classifier data is bearish alongside this. Okay, just a quick flyover of the WASDE report. We didn't learn anything. Carryouts weren't changed. Not a lot to sit on here, but I would just note one takeaway that wasn't a headline this week, but it's worth noting. World corn stocks to use jumped 3.7 million metric ton, came in above the high end of trade estimates. This was because of increase in carry in on corn, increase from starting stocks in a couple of foreign countries, not in the US. So it is, this world balance sheet did get a little more bearish. So if you look at all that and say, I think this is a good time to just remind we're not trying to sell a story, if you will. We're not trying to convince a narrative. We don't have a finished endpoint. We're trying to say what's most probable. If we look at all that together, we would say it is just very unprobable, very low probability, unlikely that grains would continue to rally from here without at least some sort of meaningful correction. And it's not that far-fetched that this is a significant high. Again, that's not a prediction. If that looks ridiculous a week from now, it's just saying that's what this data is telling us. That's what it's saying. And more often than not, that would be the case. So counterpoint, fair and balanced here. What would have to happen for that not to be the case, for grains to keep rallying here in the face of this news? So obviously, and I got these out of order here, and not that we even need a placeholder graphic, but the Iran situation, if this continues to devolve, if you continue to not have oil and fertilizer able to ship out of the Strait of Hormuz, that's going to keep a bid under the markets. It's going to keep volatility. It's going to keep things uncertain. Parallel to this, you do have, although these have been traded, they're not new, but you do have these structural stories that are biofuels expansion, the leaked RVO volumes for renewable diesel, the E15 45Z language moving forward, and then parallel to this, demand, just Chinese corn prices continuing to rally right along US, the likelihood that they have to import grain at some point. So this is your setup. If you take this narrative a little further, just the idea that urea prices have skyrocketed. If I don't have my fertilizer locked in, I'm probably going to back off on corn acres. This is way more nuanced than just a headline and a chart like this, but that's the perspective today. So that's my story. If I say, Dave, all that is nonsense, you can take your signals, your market gauge, your classifier, your cash market readings, your stocks to use, all that, and just shelve it, because I know this market's going to keep rallying no matter what. Your stance on that, can we find any support for this? There is, in fact, one year that is very analog to that, and that would be 2008. Let me find this seasonal comparison or just not have it. There we go. So white line is 2008. Orange's line, I think that's orange. That's this year. And basically you had really similar setup, circumstances different, but similar setup in 2008 to 2026, where you had more than enough cash grain. You had wide spreads. Spreads got wider as the market rallied, but you had, what did you have? You had crude oil up over $100 a barrel, not because of war thing, but because of surging global demand and whatnot. And you also had, what else? You have expanding biofuels, not because of these waivers, but because of the RFS itself, RFS2. Way more impactful demand implications there. You had built-in structural corn demand expansion like we've never seen. So, but basically that is the closest analog you had. That's where in that year you had the conditions we have now. Forget about this dip. This is unrelated specifically. I wouldn't draw that corollary. What the point we're wanting to make is you had similar conditions to this point, and you kept rallying further in the face of these analytics. Otherwise, there's no other scenario where that proved true. And basically what happened in that year, you rallied up to this was where you'd priced in the new demand, the new crop demand, weather issue here, floods, again, floods are no good. And they weren't that year. You peaked in June. You were all the way back below $3 futures by harvest that year. Some of that was driven by the economic crisis, the meltdown and whatnot. So and I share all this and lay it out this way just to make the point that you're at this critical inflection. We talked about a week ago that the war premium, using Ukraine as an example, will be priced in the first couple of weeks, and then you're not nearly sensitive to what's going on in the war. So it's been 2 weeks now. We likely have priced in most of that premium. We've got all these other tells. We're going to find out quick if we're actually able to sustain this rally in the face of that, and what it would take, what sort of news it would take. But otherwise, this is certainly, if we're looking at risk management at all, this is a spot to be taking some sort of action, some sort of hedging, et cetera. This fits all the traditional criteria. If you're handed this setup exactly as it lays today, 10 more times in your career, not 9 of them would see price to go on to some degree of correction, at least in the short term, if not more significant. So that's the takeaways now. We're at a critical point. We said on March 1st, the next week's commentary would be more interesting. We said it again on March 8th. I think it's true again this week. We're going to find out next week if that next leg higher can happen, even in the face of all this warning signs that we have. So stay tuned. Next week's market thoughts will be more interesting than this week's, almost guaranteed.